good evening, ladies and gentlemen. As publishing director at Penguin Random House, it's fantastic to have you all here at the launch of John Mills and Bryan Gould's highly readable, tightly argued, and incredibly timely book, Call to Action: Britain's Economic Problems and How They Can Be Solved. Now, the book might be small in size, but it's very big in message. And to tell us more, I'm going to hand over to Liam Halligan, well known for his economics agenda column in the Sunday Telegraph, and author John Mills himself.
Thank you. Thank you very much, ladies and gentlemen. A fantastic turnout. Thank you to the RSA for hosting this event tonight. I'm honoured to be up here on stage with John Mills, discussing his book with Bryan Gould. So economists are, for the most part, we're experts. We don't know what we're talking about, but we like to make you feel as if that's your fault. And in these, I'm an economist, and so is John, of course. In these troubled times, amidst commercial turmoil and financial volatility, I think we should be dubious about listening to the forecasts of economists, and that's coming from me, of course. Economists, like John and I, we're people who took A-level maths, but we haven't quite got the personality to be accountants. We're dismal scientists, aren't we, with physics envy. We're the kind of forecasters who'll tell you tomorrow why the outcomes we were predicting yesterday aren't coming true today. I must say, though, in defense of economists, ladies and gentlemen, we're not the only ones who occasionally come up with dodgy predictions. Consider these gems from business leaders throughout the ages. This telephone has too many shortcomings to be seriously considered as a means of communication. The device is inherently of no value to us. That was the Western Union board memo in 1876. Who the hell wants to hear actors talk, said H.M. Warner of Warner Brothers in 1927. And there's no reason why anybody would want to have a digital computer in their home. That was Ken Olsen, president, chairman, and founder of Digital Equipment Corps in 1977. Yet so often, of course, it's economists with egg on our forecasting faces. Consider this from Irving Fisher, economics professor at Yale, no less, and one of the most celebrated dismal scientists of the 20th century. Stocks have reached what looks like a permanently high plateau, he once wrote in the New York Times, the day before the 1929 Wall Street crash. Now, John, who I'm delighted to meet, I've read your book and thoroughly enjoyed it. I read it in one sitting, not on the loo. John is both an economist and a businessman, so I don't know what that should tell us about his forecasting abilities, but we can be absolutely sure about the extent of his financial acumen. John, of course, is chairman of John Mills Limited, which he founded, legend has it, in a basement in Camden some 30 years ago, a consumer products company which now sells across 85 countries. He's also a lifelong Labour supporter, and indeed is Labour's biggest private individual donor. But he's ferociously independent, as we all know. He often takes issue with the Labour leadership, sometimes seems to take pleasure taking issue with the Labour leadership.
I think the papers enjoyed that.
We could discuss that on the mansion tax, on EU referendum, on the 50p top rate of tax. But while he's a card-carrying economist, of course, he really can write very well. And any of you who've read the book will agree with that, I'm sure. He doesn't speak in riddles. He admits he can't predict the future, but he does have the courage to say what he thinks. In so many ways, he's precisely not what most economists are, and I congratulate him for that. Manufacturing jobs in the UK down from 4.3 million in 97 to 2.5 million in 2012. That's what we read in John's book. In 1972, 32% of our GDP was manufacturing, falling to 14% by 97 and 10% last year, compared to 21% in Germany and 19% in Japan. Low productivity and a lack of investment. That's what this book tells us about here in the UK. John, of course, also feels strongly that sterling's heavily overvalued And the centrepiece of this, if I may say so, very elegantly written book is, of course, a call for a lower, more competitive value of the pound. Now, John, I'm going to ask you to kick off the interview between us, which will be followed by questions from the audience, with an open question. Why did you write this book? And I understand you've got a few slides that you'd like to show us at the outset.
Well, I've been interested in economics forever, really. And to be honest with you, the views that I've got now aren't all that different from the ones I had maybe 50 years ago when I was at university. And, I've watched the situation change and deteriorate, really, over the years. And I've written a total, I think this is my 9th book altogether, some of which I wrote with other people, including Bryan Gould, actually. We wrote one together, must have been 30 years ago now. So I've always been very interested in this, but it seemed to me that particularly after the crisis in 2008, that economics as an academic subject had lost the plot, and that the commentariat and the kind of political class generally in the West had really made a real hash of the way they were running the economy with no growth. This is really what prompted to try and draw all these various threads that I've been interested in over a long period of time together to put it together to see whether it's really possible to get a much better prognosis for the future. So that was the reason for doing it. But just to run into what I think the problems were, if we can just move on, just run very quickly through. The first is that the rate of investment in this country is unbelievably low. It's 14% on the old definition that's used internationally. And
of GDP?
Of GDP.
And it's more like 20 in Germany.
Funnily enough, it is higher in Germany, but the real problem is that if you take off depreciation and you allow for the increase in population in the UK, there's just about nothing left at all. So everybody worries about why we haven't got any productivity, but if you've got no investment, you won't get any productivity increases. That's problem number one. The second is that about half of all our exports are manufactured goods, and with only 10% of GDP coming from manufacturing, there just is not enough to sell to the rest of the world. And as a result of this, we've had balance of payments problems that have gone on and on and on. The last time we had a surplus on manufactured goods was 1983, which is now 32 years ago. And on top of that, we've got mounting transfers abroad to the European Union with remittances from people who have migrated to this country, with the aid program. And then there's another huge problem adding to our balance of payments difficulties, which is that we used to have quite a substantial net income from abroad, running at about £20 billion a year. And this has now swung round to being negative this year, about 30 billion.
So we've got big negative on manufacturers, big negative on net property income from abroad, which has been positive, certainly for most of my adult life. We've still got a surplus on services, but the overall is a big external negative.
It is. It's about £100 billion a year. Yeah. Now, to finance this, you have to borrow or sell assets to close the gap. And we've just got deeper and deeper and deeper in debt as a result of all this. And really, I think what's happened over the last 2 or 3 years is that because of the quantitative easing that's taken place, there has been some improvement in consumer confidence, and property values and shares and so on have gone up, and this has lifted consumer spending. And that's drawn quite a lot more people into the labour force, which is a good thing in itself. But the reason why there's so big an increase in employment is that productivity increases haven't gone up. So there's a real bind there, but there's no continuity about this. I mean, the only way really of getting a higher standard of living is for productivity to go up.
So we've got low investment, low manufacturing, and that leads to a chronic balance of payments problem. That's number 3. Then we've got number 4.
It's the debt problem.
Sure.
We're just getting deeper and deeper in debt. And what increase in GDP we have got at the moment is very largely driven by asset inflation, which can't go on.
And then, so that's your 4th one, and then your 5th issue is, inflation. Okay, very good, very good. Let's just talk a little bit more about, before we get onto the exchange rate, I think a lot of people want to hear your views on the exchange rate. That's really the call for action in this book. Let's just talk a little bit more about the external deficit. Why is it, John, that when I was a young adult, when I did my A-levels and economics degrees and so on, the balance of payments was front and centre in the news agenda? It seemed it was on. balance of payments numbers with Joan Thurkettle on ITN News. I see Richard Linley's here in the audience, another ITN legend. But then suddenly we don't talk about the balance of payments anymore, even though we've now got, as you've pointed out in this book, the biggest current account deficit actually for 3 decades.
Well, I think what happened was that when we had fixed exchange rates, as soon as the pound started to wobble, everybody really focused in on what the exchange rate was. Once we moved to floating exchange rates, that sort of interest disappeared. And, I mean, right across the Western world, people have just lost interest in it. And it's always seemed to me that what you needed to do to run any economy like ours successfully is you need a reasonable fiscal policy, you need a reasonable monetary policy, but you've also got to have some relationship with the rest of the world which makes some sense and allows you to compete in the world, and we've just lost sight of this completely.
Now, a big part of the economic landscape since the Lehman collapse, since the subprime crisis, of course, a big part of our response has been QE. I've personally taken a lot of flack because I've been railing against QE, not quite since it began. I accepted there was a need for some emergency measure at the very beginning. But QE then, in early 2009, it was meant to be £50 billion. It's since turned into 375 billion, almost 8 times more. And the Bank of England's expanded its balance sheet 4-fold in 6 years. Now, I'm really concerned about that. Are you concerned as well?
Do you know, I'm really concerned. Do you know the monetary base in the UK has gone up by 1,000% since 2000.
Sure.
1,000%.
Sure.
In the States, it's gone up by about 600%. I mean, it's just absolutely staggering.
So why aren't more people talking about it? Why are the political classes not jumping up and down? Why do columnists like me get hammered on Twitter when we say that QE is a bad thing?
Well, I think it was supposed to be stimulating the economy and getting the economy to grow more, but I don't think it's really done that at all successfully. What it has done is to push up asset prices, but what it hasn't done is to lead to much lending to productive companies.
And why do you think that is? The banks say there isn't demand for lending. Do you buy that, or do you think the banks just don't want to lend?
I think there's some element of this because businesses are reluctant to invest if they can't really see the growth coming along. So I think there's been, to some extent, that problem. But I think also the problem is that at the same time as you've had quantitative easing, you've had all these pressures on banks to increase their capital ratios, which means they've got to reduce the amount of lending they do, so that the net effect of all this hasn't been anything like as effective as everybody hoped it was going to be.
Some of the big emerging markets of the East, of course, particularly originally the Brazilians, Guido Mantega, the finance minister, coined the phrase, accused the West of conducting currency wars. They accuse us of deliberately debasing our currencies in order to try and generate competitiveness, in order to devalue the debts that we now owe them. Of course, a lot of the flows in the world these days are from emerging market creditors, famously the Chinese, to developed market debtors, obviously famously the Americans, but us to a lesser extent. Do you think the emerging markets are at all justified in using that phrase, currency wars?
Well, up to a point. Let me show you the next slide, because this really is a wake-up call. Now, what you've got here are 2 lines. The blue line is what the Chinese have done with their currency. These are wage costs per unit of output. And the orange line is what the UK's done. Now, let's talk about the orange line first of all. It starts off in the 1970s. When we were not doing all that.
An effective exchange rate, just to clarify to nerdy economists, an effective exchange rate, that means it's trade-weighted across a range of currencies that the country trades with mostly.
Correct.
Very good.
And it's wage cost per unit of output.
Perfect.
There's various different measures. This is the wage cost one.
Carry on.
Now, we started off in the 1970s. We then got involved in monetarism, and the exchange rate went up by the early 1980s by about 60%. It then wobbled to and fro a bit, went down a bit when we came out of the ERM in 1992. And then in the 2000s, we got involved in a massive sale of UK assets.
Yes.
We sold our rail franchises, we sold our football clubs, we sold our ports, we sold our airports, we sold chocolate factories, everything. And as a result of this, there was an enormous inflow of capital to this country, which pushed the exchange rate right up. So by the time you get to the 2000s up there, it's about twice what it was in the 1970s. And then it dropped down a bit between 2007 and 2009, and now, mainly as a result of loads and loads of property sales, especially in London. It's now been creeping back up again.
And that's Exhibit A in your explanation of why British manufacturing has declined and Britain's export performance has deteriorated over that period.
Well, if you look at what happened to the Chinese came into the world market about 1980, and they got their costs down by 75%. And just look at that gap that's been left there. And what happened as a result of all this, and this is not just a British problem, this is a Western world problem, is suddenly it became cheaper to manufacture more or less everything in the Far East than it was in the UK.
Sure.
And all the low-tech and medium-tech firms that we had, I think 10,000 firms closed in manufacturing companies turned in the 1980s in just 2 or 3 years.
And that, of course, has driven
bloodbath.
regional inequality, social inequality.
It really has, because what we've essentially done is we've tried to sell our labour at far more than the world is really prepared to pay.
Sure.
And this is why we've got a long tail of people, maybe half the people in the country, who are in relatively insecure, low-paid jobs.
So we've tried to sell our labour for a lot more than the world is willing to pay.
Exactly.
What would a Labour man say about the role of trade unions in keeping labour costs high? Would you think trade unions have undermined our adjustment?
Well, I think what they've been is enormously weakened by all this. And as a result of this, I mean, pushing up wages even more in these circumstances looks after the people who are still in jobs, but at the expense of everybody else. What you really need to do is to lower the real cost that you're charging the rest of the world for our labour costs, and then you can employ everybody. And then I think you do need strong trade unions, because one of the problems we've had in this country is that the proportion of GDP that goes to wages and salaries, which was around about 65% in 1970, dropped down. It dropped down to about 51%. It's gone up a little bit more. It's about 55 or something now. So that vastly much more of the GDP's going on profits and dividends and interest and this sort of thing, rather than wages than was before. And this is partly because the trade unions have been very severely weakened by what's gone on.
Now, your Chancellor John Mills would do everything in his power, of course, to try and lower the value of sterling. But some people would say, but John, look around you. Yes, the pound has gone up against the single currency, particularly as it's become clear that we're going to have big time over Eurozone QE. But against the dollar, the pound's at a 5-year low. So what you want has already come about. How would you answer that?
Oh, well, up to a point. I mean, I think what's happened is that really it's not just Britain that's in the situation that you see up there. Basically, the whole of the Western world is on that orange line. And the whole of the Far East is on that blue line.
Yeah.
And what's happening is that the Western countries are trying to compete against each other to get some competitive advantage. But there's still a massive, massive gap between them
and the rest of the world.
Well, where people like, not just China, but Malaysia, after the 1997 crisis, devalued by about 40 or 50%. So did Thailand, so did Indonesia. So all these countries are actually still way, way competitive compared to anything the West can offer.
And the emerging markets, of course, count for more than 50% of GDP in the world, 3/4 of humanity, 4/5 of global currency reserves. They're pretty powerful. So I must say, in your book, I found the analysis extremely persuasive. The use of data, very, very punchy writing. It was genuinely riveting to read. Where I took issue with you, and I wanted to ask you this, was on your diagnosis. Mm-hmm. If at a time when we've had enormous quantitative easing, as you've said, you still think the currency is valued too high, what on earth would you do to bring the currency down to the kind of level that you want to see?
Well, I don't think quantitative easing has actually been all that effective in bringing it down. It's brought it down a bit.
Do we need more?
No, I don't think that's... I mean, I think there are 3 ways you can bring the currency down if that's what you want. The first is we need to stop selling wholesale all our assets.
Yeah.
No other country in the world sells off assets like we did. The French had a yogurt company, Danone, which they
strategic yogurt company.
It was a strategic yogurt company. But the French authorities would not allow that company to be sold. Yeah. What happened to
US ports?
Yes.
They wouldn't sell to Dubai ports, right?
No, they wouldn't. And there's been restrictions they've got to be reasonable. But I'm not suggesting you bring up the drawbridge and don't sell anything at all. But I mean, what happened was we abolished the Monopolies and Merger Commission in 1999, which had a public interest test.
Yeah.
This was replaced by the Competition Commission. This is the time when the markets knew best over absolutely everything. As long as there was competition, didn't matter who owned the business, didn't matter who ran it, and there was no public interest test at all.
So that's one, flog less stuff abroad.
Flog less stuff
Two.
at all. You've got to get the Bank of England on side.
And what can they do to bring down sterling to the extent
they
that
sell
you want,
rather buy.
specifically against the big emerging market currencies? What can they do?
But I mean, essentially, they stop supporting sterling the way they have done over the years and let it run down and become weaker. But finally, if you really, push comes to shove, if you were the Chancellor of the Exchequer, you stood up in Parliament and said, I think 155, or no, it's about 148, I think, today, is far too high. It's got to be down to 110. What I'm going to do, this will take some courage. What I'm going to do...
You talk it down.
Yes, is to increase public expenditure, reduce taxation. I'm going to widen out the balance of payments deficit temporarily until you, the markets, realise that I am serious about 110. And I think you would then find it would be 110 within a relatively short period of time.
Some economists would say, straight back at you, that's inflationary. Our imports will become much more expensive, and you're confiscating wealth from your own people who have saved their assets in good faith in sterling. They live in a globalised world. You're undermining their ability to purchase goods and services.
Well, let me answer. There's two questions separately. First of all, it is a myth that inflation is always caused by devaluation. I was taught it was when I was at university, and I believed it. When I actually looked at the figures, what did I find? Wasn't true. Wasn't true. There were a whole lot of other factors that clicked in when you have deflation. You can have lower interest rates, you can have lower taxation, you have longer production runs, all this kind of thing. And what you actually find, if you look at the numbers, is that there's very little correlation at all between devaluation and inflation. On the other point about values changing, there are costs there. There are costs there. And, you know, some...
And it'll be the wealthy who see this coming and they can shift their assets, they can call their broker...
They can, but in
How
the
about
end...
just small people who've saved all their life for a nest egg? Maybe they're trying to buy a house in Spain. You could be...
In the end, everybody's going to be better off if you can get the economy growing at 4 or 5% per annum instead of mouldering along the way it is at the moment.
OK, just before we throw it open to questions, of course I want to do that. Let's just talk just a little bit about domestic politics, if I may. You've obviously... completely openly, and it's your right, and lots of people congratulate you for it, taking a part in British politics, not just as an advocate and all the rest of it, but as a donor. Does the system we have in the UK of political donations, does it worry you? What changes would you like to see in our system of political donations, or do you think it's about right?
Well, I can tell you all about how to sort out the British economy. I can't tell you how to sort out the question of how to fund political parties. I mean, 80% of the electorate do not want to have political parties funded by the public purse, which means you've got to have some other way of doing it, and then you finish up with donors. Now, I don't think that necessarily having it all done by donors is the best way ahead, but that if people are just not prepared to find any other way of doing it, that's what you're left with.
Isn't there so your argument would be as long as there's transparency, it's fine. Do you think there should be a limit on what a particular individual can give? Obviously, you've made your money, you within the law, you've employed many people. Everybody here would doff their hat to you. But shouldn't there be a limit on what one individual can give? I mean, your donations outstrip many trade unions, the subscriptions of often thousands of members. Is that right?
I don't think there's any perfect solution to this. I mean, the trouble is that if you restrict it all down to, I don't know, £500 or something, £1,000, you just don't get enough in. I mean, there are
maybe politicians will spend more time in car parks talking to people and less time flying around in helicopters then?
Maybe they would. I mean, the answer is there's no happy solution to this problem.
And do you enjoy being a donor? Do you enjoy the kind of platform it gives you?
To some extent, to be honest with you. I mean, I'm about up here with the media. You know, whatever I do, it's the territory. It gets twisted, and I've only got to make gentle comment, and there's a big split between me and Ed Miliband and all this sort of thing, which
What do you
I
think
get
of
absolutely
him?
fed up with.
What do you
all
think
this.
of him?
I think he's got. I think he's very good at a lot of what he does. I think that he would really move into the job and do a really good job if he was there. I think he's had a shockingly unfair press from the Tory press over the last few months. And I think he's incredibly resilient. I think he's stood up to all this.
But he
really
seems to
well.
have ruled out a coalition with the SNP today. You're happy about that, right?
Well, I think what he's done actually is quite a clever move, which is saying he won't have them in the government
But
at
he's
all.
kept his options open.
But he's kept his options open.
power
I mean,
sharing.
I think anybody sensible would do that running up to an election.
Yeah. Okay, that's fantastic. Let's have some questions. I know there's many people in the audience who want to ask a question. Just tell us who you are, sir. Sorry, I should have asked.
Eric Dickens. I confess I'm not an economist.
Three.
But my question is a very simple one. Given a 50 or 60% devaluation of the pound against all the major trading currencies in the world, where is the increase in our exports to come from? In the book, you say twice, you talk about light industry, light manufacturing, which for me, having worked in industry, suggests kitchen equipment, motorcycles, cycles, and things like that. Areas where for the past 40 years, the Asian tigers have really dominated. How on earth are we going to make up that gap?
So you produce this massive exchange rate stimulus. Where's the demand going to come from?
Well, I think the answer is the demand will come from all over the place. I mean, there's been, to be an economist for a moment, there is a big issue about what is the elasticity. To what extent are exports price sensitive?
That's right.
And lots of work's been done both by the IMF and by the academic world of what those
So
numbers
what are we
are.
going to sell the rest of the world? If you've got, as a gentleman says, folk in Asia making light industrial products better than we are already.
Well, the answer is that they're doing it better because their cost base is far, far lower. But I mean, part of what we need to do isn't just to sell more abroad, although we do need to do that. Why are we importing all the toys that we sell from China? Why can't we make them ourselves here? There's a whole mass of things which actually, because they're bulky, because they're cost structured and so on, would be reassured if you had an exchange rate was maybe 20 to 30% lower. Cement. Do you know we hardly produce any cement in this country? Yeah. And the reason is the costs are far too high for producing cement here. Now, to say we can't produce cement when the place is, the whole island is one big limestone outcrop, it's absolutely ridiculous. I mean, the answer is that some industries would be much easier to reshore than others. But if you look at all the elasticity figures, what they show is particularly if you have a reasonably deep devaluation, there's enough to get yourself back into balance.
And you think if the opportunity of a price stimulus comes, entrepreneurs will spring up to meet the demand, I guess?
I think there's absolutely no evidence whatsoever that people in Britain are entrepreneurial. If they've got an opportunity to make money, that's what they'll do.
Gentleman at the back, say who you are.
Thank you, I'm Kwasi Kwarteng. I'm a member of Parliament from a slightly different political persuasion to yourself.
Not that different, actually.
Well, you haven't heard my question. The thing that really struck me was this Chinese. I'm going to ask a very specific question about the Chinese currency and what you hope to do with the British currency. I mean, what they did was a deliberate act of policy. So we had that chart in 1980 where the renminbi was at 1.5 to a dollar. And then by 95, they were down to about 8 or something. And that didn't just happen. That was something that they did deliberately. So in a way, I mean, the Americans used to call them currency manipulators. And in a way, that's what they were. And they had a very protectionist policy. And what I want to ask you is, how do we avoid a kind of competitive devaluation situation that we had in the 30s if we followed the model you suggest? Because it was a deliberate act of policy that produced the export-driven growth that China sees today.
Well, ideally, what I think you need to do is to have a world change in the way currencies are valued against each other. What I think you need to do is to get the world, broadly speaking, into a situation where every country has enough manufacturing to be able to pay its way in the world. And manufacturing tends to generate higher productivity increases than services do, so you can kind of balance the world out in a better place.
But you can't legislate that for that, John. You can't hold a summit and say you're going to have X amount of manufacturing, Mr. Japan, and you're going to have Y amount, Mrs. Malaysia.
No, I completely agree with all this. But I mean, if you're in our position where I think you have far, far too high a value for our currency compared to all these other ones, what at least you can do is to start here. And I think that if we really were determined to get the value of the pound down by maybe 30% or something, which all the analysis in that book suggests we would need to do to be able to rebalance our economy in the way that I think we need to, I think we could do it.
But also underpinning Kwasi Kwarteng's question, I imagine, is a sense that in the 30s you had these competitive devaluations, beggar thy neighbour policy. It was extremely controversial. It led to conflict. It led to military conflict, some historians would say.
Well, what you need to do is you need to get world demand up. That's what you need to do. And the way to do that is you've got to remove the constraints on lots of countries which can't get their demand up because they've got balance of payments problems and therefore are unable to stimulate their economies and get them to grow more quickly. That's the problem. You need to get rid of those.
There's a lady there. Thank you for waiting.
Anne Pettifor. John, that chart shows that I just want to follow up on the last speaker. Sorry, Anne Pettifor, Prime Economics. The fact is that the Chinese manage their currency. They have capital controls. And what happened in the 30s, Liam, was that countries managed currencies and they coordinated the management of currencies. We've abandoned that and we leave it to the market. The Chinese don't leave it to the market. But, John, if we were to have capital controls, that would affect you and your business, wouldn't it?
Well, I mean, I think that there are worse things in the world than having capital controls, and one of them is having economies that stagnate for decade after decade. I mean, I don't think actually you do need to have capital controls. I think you can do it without having capital controls.
Can you even technologically have capital controls these days? I'm just about old enough to remember filling in little pound signs in crayon in the back of my mum's passport. But can you really have, is it really technologically feasible to have widespread capital controls these days?
I'm not suggesting that we should do. I mean, is it possible? The answer is you have to have a very different financial structure than we've got at the moment. It could be done, but I don't think it's the best way of doing it.
There's a gentleman here who's been very patient. I'll come to others.
Yes, I've spent much of today in waiting rooms in hospitals, so I've had the opportunity of reading the book up to the final chapter, and I must say that 85% of the analysis I think is very good. There are some very quotable statistics in the book, and I've spent the afternoon... And I've been tweeting them without acknowledgement, with all respect, because they do put... Well, they come from impeccable sources like ONS and HM and so on. But the thing is this. I do agree with the very bulk of your analysis. Just some points that I think are worth picking out. Individual saving rates very low. Companies sitting on cash and not investing it in industry. Land banking, I'm not sure you mentioned, but one could mention that as well. Poor investment in industry, particularly the small and medium light manufacturing and so on, and too much emphasis on asset value growth, and I'm not sure you mentioned it, but dividends therefore resulting not really from genuine profit from activity, but from asset growth turned into profit. I think that's all true, but the diagnosis, which is it's all to do with our exchange rate, I'm less sure about. And what I think is we first need to do is to reshift the emphasis into investing on a risk base into entrepreneurial activity, entrepreneurial investment, getting individual people, families, small companies thinking about risk-taking in their investment. I don't think there's enough of that at the moment. Companies are too keen on doing what they've previously done. We've always been making widgets, we'll go on making widgets. So I think that's the first thing. And the second thing is, we are so obsessed... I realise that. We're so obsessed with making profit from our own homes that we gear ourselves massively into the buying of our own homes to the exclusion of almost any other
investment
activity. The overwhelming bulk of this country's population has one investment, their home, and that doesn't produce any kind of entrepreneurial activity.
Well, I think what we really need to do in this country is you need to have more manufacturing industry, and the only way you'll ever get it back is by making it profitable. What the exchange rate changes that I recommend in that book will do will make it profitable, and that's what will happen. I think you're absolutely right about this. If you look at the where banks lend money, it's almost to an obscene extent on property rather than on any sort of manufacturing operations.
Property that's artificially inflated in some parts of the country by a shortage?
Partly by shortage and partly also by quantitative easing.
Right, there's lots and lots of people who want to ask a question. Gentleman there, could you ask a short question and then pass the mic forward to the young man in front of you? I'd be really appreciative.
Yeah, I will.
Thank you.
Essentially, the solution you're offering, or a solution that you're offering through devaluation, is still laissez-faire. And I just wondered if there are other thoughts and ideas that you might have that would reflect the kind of approach that Heseltine took when he talked about intervening before breakfast, lunch and dinner.
Okay, hold that thought. The gentleman in front of you. Thank you, sir.
Adam Ramsey from Open Democracy. I basically accept a lot of your analysis, John, but one thing that often it strikes me about what you say is that there's basically a political economic argument that seems not to be articulated in the middle of all this, which is a battle between the city and manufacturing, in that it's good for the city to have a very expensive pound and it's bad for manufacturing and a lot of other bits of industry. And I suppose my question is, why is it that you don't make that case more, or do you disagree with it?
Okay, and then the gentleman just here, very briefly.
Thank you. I realise that your focus is principally the dynamics of the British economy rather than the dynamics of international finance capitalism. But and so you can fend this question off if you want to. But I read recently a book by Damien McBride about his time in politics, which Damien is, whatever else he is, he's not a noted economist. But
it's only a matter of time.
In commenting on what we'd just been through and the great crash, he said, but you ain't seen nothing yet. We're storing up the makings of another crisis of the same kind, and it'll be on a much greater scale that we perhaps won't be able to more or less wriggle our way out of in the way that we're doing out of this one. I wonder if you've got any comment on that.
Do you buy that?
Well, let me take the question in turn. First of all, I don't think that getting the value of the pound down is the only thing you need to do. I think there's a huge supply side agenda that you need to really get on
so it's
to
no
as
panacea, but it's
no,
necessary.
it's not a panacea. It's a necessary but not a sufficient condition. Okay. So there's a lot more that needs to be done. On your point, Adam, about the city, I mean, I think that cities' interests and proclivities just are not necessarily the ones that suit manufacturing. So the city on the whole likes having a fairly high pound because that gives it more leverage overseas. The city I did a calculation about how much the city made out of selling all those assets. £40 billion was my estimate for what they made on fees and charges and commissions on selling all those assets. It's a lot of Maseratis, but they were understandably very keen to see these sales going on, even though it wasn't in the interest of British. Do you know, 2/3 of any reasonable sized manufacturing in this country is owned overseas. On your point there, I think that the 2008 crash was very largely a private sector affair. I suspect the next crash that's coming is going to be a public sector affair, because there's just so much money swilling around and so much risk attached, particularly in the Eurozone, which could topple banks and start having a knock-on effect all the way down the line.
What do you think of the fact that British public sector debt has increased from about 750 billion at the time of the crisis to almost 1.6 trillion now? Is that a problem?
I think it's a huge problem, and I don't know how much time we've got. I mean, there's quite an interesting slide I've got, which is...
Go for it.
Okay, let's have a look at... This is about what to do about the deficit.
All right.
This one here. This is a slide that it was published every quarter by ONS, which doesn't really mean anything. But it's borrowing and lending inside the economy, but it doesn't sort of hit you. If you looked at the next slide, these are the same figures, but now what you see is that all these figures have to sum to zero. All borrowing has to equal all lending. Now, what's happened, if you run there's quite an interesting history of the British economy over the last 5 or 6 years. From 2008, we were more or less in balance on the balance of payments. The households were borrowing quite a lot, businesses were making quite a lot of money, and we had a public sector deficit of 70 billion.
Which is still big by historic standards,
yes,
right? A £70 billion deficit was still huge.
And it was. But if you look at what happened, the deficit then doubled, and the reason for that is that the household sector stopped borrowing and deleveraged. The corporation sector, that's the businesses, just made pots of money, and the residual really is the public sector, and that's what produced those big numbers from 2009 to 2011. Now, if you look at what's happening now, on the right-hand side there, you've got a balance of payments that's rapidly going worse. That bottom line is only the first 3 quarters of the year.
The 73
So that's going to finish
billion,
up, I think, about 100 billion. You've got the household sector and the corporation sector just lending a little bit, borrowing a little bit. And the balancing figure there is about 100 billion on the year.
Yeah.
Now, the real 64...
It'll be our 6th year in a row when we've borrowed around about 100 billion or even more.
But the $64,000 question is, can you get that deficit figure down if the foreign balance figure stays high?
I see.
And so I think the answer to that question is no, you can't.
Yeah.
And if you run a policy of reducing government expenditure by 35 billion or whatever the Conservatives are now talking about, all that'll happen is you'll just tip the economy into recession because you won't reduce the balance of payments deficit. You'll get these people in corporations and households getting more negative, and the residual factor will just stay as high.
So to get that foreign balance down to a respectable level and, hey, maybe even into surplus, there's a novelty. Is our trading future in the EU or is our trading future beyond the EU?
I mean, to be honest with you, I don't think the EU makes a fantastically large amount of difference to all this. It would do if we were in the euro. If we were in the euro, there's nothing we could do about it at all. But we're not in the euro.
Yeah.
Could the EU stop us having a policy of getting the pound down? No, I don't think they could. They haven't got the structure there for
But you want a referendum, right?
Yes, I mean, I think that my own personal position is we'd be better off staying in the EU if we can get the terms of membership radically or substantially changed. That's my position.
Which is also Boris Johnson's position, by the way, which is
fine.
fine.
It's quite a lot of people's position. I think most people in this country think that.
I think most people in this country think that as well. And so do you think we will see a referendum pledge from Labour at some stage?
I don't think we will see one this side of the election, but there are a number of things that might trigger off a referendum. I mean, there's the referendum lock legislation.
Of course.
Ed Miliband's on record saying that if there are really substantial transfers of power, there would be a referendum. So I think it's possible there might be.
The gentleman here has also been extremely patient. I'm really trying to get everybody in before time beats us.
Kelvin Hopkins, Member of Parliament and a very strong supporter of John and all his works. And a good friend, I hope. I think I think some of the speakers.
I think the next 15 seconds will determine the answer to that question. So.
No, I think. But
off you go.
I agree with everything, but I think we need to go further. I think Keynes and Bretton Woods had it right. We had pegged currencies, the possibility of devaluations. In fact, Keynes said countries that had surpluses ought to be made to revalue. The current exchange rates were absolutely crucial as part of the scheme, and it all worked for 30 years after the war. Then they reinvented the 19th century, and it all went horribly wrong. I think that's where we are now. But
it's Nixon's fault.
Well, whoever. But I asked questions time and again of successive chancellors about taking the exchange rate seriously, and I never get an answer from them. Does John understand why they won't answer me in very simple terms?
Does the right honourable gentleman... Okay.
Right, well, let me just deal with Nestor's point first of all. I mean, there are ways in which you could reduce the amount of property in London which is sold to foreigners without moving to a situation where you pull the drawbridge up and we had the sort of North Korean situation. Why don't we tax these properties far more heavily if they're not occupied most of the year, for example? So I think there's lots of things you could do. Why don't we have a public interest test for takeovers? Why are we selling the Trustee Savings Bank for £1.7 billion this week? Why are we selling all these assets off on this scale?
So you'd have a tax on homes in London that aren't occupied how many once of the year?
How
about if I get my Filipino maid to live there? I'm being serious. I mean, won't people get round it?
There's no...
But you're against the mansion tax, right?
Well, I think you ought to tax properties much more heavily. I don't think mansion tax, to be honest with you, is as good a way of doing it as widening out the council tax bands. I'm not at all against taxing properties. But you know, I think there are ways in which you could restrain these vast amounts of capital imports, which would, you know, do a lot actually to get the pound down. So that's what I think you ought to do there. On Kelvin's question, there, I mean, I agree with you. I mean, I think if you look at what happened between 1945 and 1980, roughly, there were capital controls there, and the whole system actually worked very much better than it did now. I'm not saying we should go back to capital controls, but what I do think you should do is not try and run the economy on the basis of just simply ignoring the exchange rate. And what I would say is, we're drawing towards the end, is that if nothing else comes out of this meeting at all, I think one of the things that really is worth stressing is that however you may think the details work out, the exchange rate is an extremely powerful determinant of what happens to the economy. And this ought to be on the agenda in a way which just simply isn't at the moment.
Ladies and gentlemen, it's been a tour de force. Thank you for all your questions. Thank you again to the RSA for having us. And thank you most of all to Bryan Gould and John Mills for writing this fabulous book. Thank you very much. Well done.